Good afternoon, everyone. I'm Bob Green with the National Association of Investment Companies, and I'd like to welcome you to another episode of the NAIC Insights series. My guest for today is Michael Miller, the Chief Investment Officer for Colonial Consulting. Welcome, Michael.
Thank you, Bob. I really appreciate you having me here today.
No, we're happy to have you. Glad you could be with us. So, Michael, we're going to spend a little bit of time just talking about the industry. We've got a nice audience assembled, and they're all particularly curious about a number of topics. And I think you'll be very helpful in providing them with your insights.
Great. Looking forward to it.
Good. Why don't we start at the top, Michael? Tell us a bit about Colonial Consulting. What you guys do, how big the team is, where you're located, some of your clients.
Sure. So Colonial Consulting is a New York City-based firm. We had a couple of different structures in terms of ownership over the years, but our roots go back to 1980 when the firm was founded. Today, we have a staff of 64 people. Almost all of whom are based in New York and used to come to one office in New York, but that's of course a little different today. And we work for almost exclusively nonprofit institutions, community foundations, private foundations, et cetera. People who do an incredible amount of good in this world. So they're an amazing people that we are honored to serve. We work for about 130 of these institutions, and they have aggregate capital of approximately $34 billion today. And that's essentially our structure.
Outstanding. And tell us a bit about how long you've been at the firm and what roles you've had over the years.
Yeah. So I'm a bit of an unusual person in probably a lot of respects, but one of which is what I'm about to say, which is I actually joined Colonial in 1986 as a college intern. I was hired to be a programmer and never left. So that's kind of my whole story. So I went from being a programmer to being on the research team, working with clients, and then maybe as an example, if you stay around long enough, they eventually make you CIO. I became CIO about 4 years ago. So that's been my progression. When we have any kind of an issue in the firm or any kind of a controversy or something to talk about, and I have an opinion, everyone pretty much says, well, you've never even worked anywhere else, so what would you know? And I can't really dispute that point. But that's my history. It's very simple.
Michael, I could be wrong, but in 1986, if we want to compare that to the NBA, I think that Dr. J was the very best player. He was the MVP of the league that year, and they won the championship. From a football standpoint, I don't know who won in 86, but no one can forget the 85 Chicago Bears. So, yeah, that puts it into context. You've spent a lot of years doing what you do. Congratulations to you.
Hey, thanks, Bob. And I have to say, just to add to your story, the New York Giants won the Super Bowl in 1986. As a Giant fan, I remember that quite well.
Now it explains why I couldn't remember it. I'm a fan of the Washington football team, as they call us today. So it's not a surprise that I forgot Phil Simms and Lawrence Taylor and those guys. Yep.
Yeah, totally understandable.
Absolutely. Well, Michael, let's dive in a little bit on the investment management industry. Clearly, we're at a place and time today where there are lots of issues that public pension plans face, foundations and endowments and others. Talk a little bit about your client base. You can give names if you like, but tell us some of the issues that are top of mind for them and that you're helping them with.
Yeah. So top of mind for our clients is basically the effect of the pandemic on their communities. If you go from I'm afraid of leaving somebody out, but just to name a few names, from the San Francisco Foundation to the Marin Community Foundation to the Community Foundation in Buffalo, New Haven, Philadelphia. I can go on and on. Milwaukee. See, I don't leave anyone out. I'm leaving tons of people out. They're all facing, I think, a very similar set of issues, which is the impact on people's lives, which, as we all know, are incredibly depressing and severe. And so top of mind for our clients is, where are the resources going to come from for us to do the work that needs to be done, for us to make a difference in our communities? And I think what's incredibly unique about this time is that the need is such that if it doesn't get out there soon, there'll be no coming back. I mean, lives will be destroyed, organizations will be destroyed, and rebuilding that will take decades. And so, and not talk about lives, just organizations. So there's this gigantic need for capital right now. And what we've seen clients do is a couple things. And one is, thankfully, the markets, whether they should or shouldn't be higher, at least have recovered a lot of the losses from earlier this year. So at least we're not facing that problem at the moment. But what I'm really excited about is clients are increasingly thinking about creative ways to put more money out in their communities, whether it be issuing bonds, borrowing from credit lines. There are a variety of different strategies that people are thinking of. And I just love seeing that kind of creativity and that kind of passion for our communities, our society.
So let's go a little bit deeper there. Maybe we'll talk a little bit by asset class. First, what are you seeing? I know that there's no rule of thumb and that there's going to be as many different answers as you have clients, but what are you seeing in general in terms of how plans are allocating their assets, broadly? How are they slicing the pie? And then let's talk a little bit, I'll remind you, but let's talk a little bit about some of the creative things that you're seeing in each slice.
Yeah, sure. So the overall picture, and it does vary, of course, by client, but we tend to be a fairly opinionated voice. So our client base tends to fall into a fairly, but not exclusively, narrow range. I'd say it's about 55 to 60% of assets are in public equities. It's about 15 to 20% in various forms of fixed income. And then it's another 20 to 25%, if that math adds up, in private equity, other types of private assets, and then some hedge funds too. So those are the big groups that we're using. And they're all, if you think about it, with the exception of fixed income, very much geared towards how do we generate a compelling rate of return over time.
Mm-hmm. That's outstanding. So now let's look at public equity. Public equity has always been sort of the baseline. Most people that are going to alternatives are pulling from their private equity book. I'm pulling from their public equity book going into private equity. But let's not skip over public equity. What are some of the trends and investment themes that you're seeing? What are people doing to generate alpha there?
Well, it's a very interesting time to try to answer that question. So what people are doing to get alpha in that space are either really one of two things. One is not trying. There's a massive swing towards index funds, which is just kind of I can't take it anymore. I'm going to own indexes and not try to beat the markets. The second thing people are doing is trying to invest more and more in more innovative businesses, faster growing businesses, find the winners in this climate. The challenge with all that, though, X the passive part, is that chasing the winners is actually not a very sustainable investment strategy. And so as we look out 10, 15 years or 5 years from now, will we look back on these decisions and feel good about them? And I suspect some of the ones being made today, we will not feel good about. And a rule that I know we operate with, and I personally operate with, is that you only get one chance to get this right. Mistakes can be destructive beyond belief and takes forever to get back. So you have to make thoughtful decisions. And what that leads us to thinking about a lot, and what we're suggesting clients do, is essentially go the other way. Think more about some of the great active managers out there. Think more about the people who have a real edge because of their information ability, their ability to actually value securities and companies better. This is not the stuff that's in vogue. It's not what people are doing today to succeed. In fact, it's a contributor to short-term disappointment, but it's the right thing to do long-term.
So, Michael, when you talk about indexing, and indexing is such a current theme, and you're seeing it all over the place, and there's some really good reasons to do it, and then there is a bit of a surrender in indexing as well. Help the audience understand the difference in just the pricing range of what you might pay for a public equity program that's not indexed versus what you would pay in an index environment. I want them to understand the relative difference in pricing.
Yeah. So it really depends on, what kind of public equity program you build. So if you build, let's cover it with two different kinds. If you built a market plus a little program, you're not swinging for the fences. It probably costs you, depending on the size of your portfolio, of course, 0.5 to 0.6% per year to have such a program. If you built a program, which is the kind we like to build, which are more high octane, like to us, again, back to the communities, back to the pandemic, back to everything that's going on in this world, an extra 0.5% or more of return is a really big deal on billions of dollars. So we go for more high octane. And in those programs, Bob, you're looking more at maybe between 0.8% and 1% per year, give or take, to have a more high octane program.
Outstanding. So let's move over to fixed income. what are some of the things that are going on in the fixed income space? It's been a little quiet for the past few years. Where are people finding value in fixed income, and what do you think the I don't want to say the future of it is, but where are we headed in fixed income?
Yeah, I mean, fixed income's tough. I mean, the place where people have tried to find value is with more risk, credit risk in particular, and other forms of risk, and that's unfortunately been very harshly punished this year thanks to the pandemic. So the problem with fixed income, of course, is that when you have interest rates as low as they are, the returns just are not very good. So, in a perfect world, if interest rates were higher, we'd have more than 15 or 20% in fixed income, but we're really being left with no choice because, again, supporting long-term philanthropy, which is what we're trying to do, if you're going to earn 1%, if you're lucky, on bond funds these days, that's not going to work. So fixed income is tricky. And so I think the thing you have to do with it in a portfolio is consider it as an insurance policy and a source of liquidity when you need it in the short term, when bad things happen in the world and in your portfolio elsewhere. And just accept the fact that your returns are not going to be very good. Don't reach for slightly higher returns because you're just not going to get paid enough. You're much better off in private equity, public equity, and a lot of other places.
Good. Well, we're coming around the corner now to my neighborhood. The buildings are starting to look familiar. Private equity. When I first got into the business as a trustee, there were a lot of conversations about, what's the role of private equity in our portfolio, and is it worth the risk? And it's so expensive. You don't hear those type of questions asked as much anymore. Take us from those types of concerns, Michael, to where we are today in plans, consideration of how to use private equity.
Yeah, I mean, private equity is absolutely a fantastic area to invest in, generically speaking. But you have to pick the right players, of course. That's the critical element, and you have to build. And we'll come back to this later, I know, Bob, but a differentiated team of people thinking about things differently. That's the way you win in investing any asset class, but particularly private equity. It's interesting. The pricing in private equity, the amount of capital that's been raised is disconcerting, and it does suggest that just having your run-of-the-mill private equity manager is not going to be a very satisfying experience for the next 7 to 10 years. So we are still worried about that very much. But you cannot homogenize this industry. It's just way too many people doing way too many different things. And so at the end of the day, in our way of thinking, the role of private equity in the portfolio is simple. It's a return engine. Yeah. Some of the biggest money you're going to find in terms of profits, although the public markets are offering some similar opportunities today because of the bizarre nature that they're operating under. But some of those big returns, those gigantic ones that change the game for you, are going to be found in private equity portfolios. And so again, you get the right people, it's all about the returns. And that's the reason to own private equity. And you put up with all the other pieces of it that are not as fun to deal with, like illiquidity and the fees, et cetera.
Right. And then the last one I'll sort of ask you generically about is real estate. The real estate market had its ups and downs probably, 7, 8 years ago. We thought things were stabling out, values were growing, cap rates were stabilizing, and now everybody works from home, Michael. Where are we going in the real estate space? How should people be thinking about real estate in their portfolio?
Yeah, and I'm actually mostly a half glasses half empty, half full. I got that right, half full kind of person. I think it's really hard to be optimistic about commercial real estate right now. It's just like you said, Bob. There's just too many things going on out there right now, which really could be game changing, massively changing. I tend to think that at times like this, we overstate the amount of change that will actually occur. But it doesn't take much in a lot of commercial real estate because if you think about it, you've got basically capital structures that are leveraged. And when you leverage something up and you lose the income side of the equation, i.e. the rents, you just don't make it through that. You have a disaster on your hands as an owner. So the way we think about real estate is be really, really careful here. However, because the pandemic's been as harsh as it's been and the after effects are going to be, they're hitting us right now, as we all know, there's probably a lot of great opportunities to buy assets at really attractive prices now, provide rescue financing, do those kinds of things in real estate that could be really profitable. So it's definitely it's become significantly more interesting, but you got to go in there with your eyes open. This is not low risk stuff by any means. It's extremely difficult.
And are you seeing your clients adjust and create opportunity buckets or increase funding for activities and opportunities like you just described, or is it too soon to think about that?
They're basically doing it, but doing it within their structures. So, for example, if you had, for example, a 15% private asset target in general, you're saying, "Oh, no, I'm going to do some opportunistic real estate and some other things that are more related to what the currently best places to be are." And we always like to do that, which is find the best place to be, put it inside of a bigger, more diversified bucket.
Got it. Got it. So, Michael, we have a lot of managers on the phone. NAIC, as you know, has private equity firms. We have hedge funds. We've started to get a few real estate funds, and we've started to get some broader asset managers, in the long only and the mutual fund, sort of retail side. I spend a lot of time talking to managers that want to raise a fund. A third of our membership are so-called funds in formation. And one of the things I share with them is they're going to be evaluated through three buckets: team, track record, and strategy, right? Team, track record, strategy, or also said team, track record, and execution. What advice do you have for new managers? How do you think about them? How does Colonial evaluate them? Spend some time there, because I think our audience, the opportunity to have a consultant with as much experience as you have, share insights with them is just very valuable. So how do you talk to new managers about the way they're going to be evaluated?
Yeah, that's a great question. I think, Bob, the advice you're giving them is really good. I think the thing you have to face as a new manager, unfortunately, is that you're not as much of a proven entity in some people's minds. Now, we tend to see that as opportunity, which is, hey, we can get in early with somebody who is incredibly well aligned with the interests of our clients, because this is their thing. They're doing this and they're excited about it, and they're putting literally every ounce of their soul into this right now. So that's incredibly compelling from our perspective. And then the advice we give people is basically a couple things. So one is just be yourself. Come in there and just tell us who you are. Tell us why you're good at what you do. Tell us about your record, your history, your experiences in life. In fact, our favorite question to ask any manager is, tell me your story. You can start as a child if you want to, but we want to understand who you are as a person. We then want to get into, why are you doing exactly what you're doing? How'd you get to this philosophy? Why is this your philosophy? And I got to tell you, a good answer isn't, well, I thought the market would be interested in that. We really want to see that's connected to who you are as a person. What kind of team are you building or thinking of building that will help execute on this strategy? And why should we believe that, absent this obvious proof statement that you've got a record, that you're going to be successful beyond just pure grit and hard work? We like a little bit more than that. So those are the things that we focus on. And I would also suggest that you emphasize your edge. And your edge as a newer manager is not just the alignment of interest. It's the fact that you'll probably have a smaller capital base to put to work, and the fact that you'll never be more motivated in your career than you are at the beginning to get your thing going. And so those are really big edges. And first-time funds have very good track records for a reason. And we want in. And the only thing we don't generally go for is somebody who's really much more in the idea phase. They don't really define what it is they want to do. It's just much more pie in the sky and platitudes. That doesn't really go very far with us, because we can't wrap our heads around what it is exactly about you and your firm that's compelling.
That's great advice. Let's we're going to get to the diverse manager conversation, but let's spend a little bit more time here. So if you'll accept my sort of paradigm of team, track record, and strategy, let's go down each one of them a little bit. So when we talk about team, a lot of times people in new funds will want to assemble a team of people for reasons other than investment experience together, right? They know someone, they have high regard for them, they're best available. But when you start to evaluate team, you're really looking for different dynamics other than a bunch of good bios, aren't you?
Yeah, that's an incredibly important point, Bob. In fact, I think some of the biggest mistakes we see in new launches is people doing exactly what you just said, which is you form this team. I met you, Bob. I might have worked with you for 7 years ago, and you seem like a good guy, so we get together. But we haven't spent the time to figure out if we can actually work together, and we're really going to be successful, really going to be compatible with each other as a team. And so what happens is people end up with dysfunctional teams, and you see it happens quite a bit. They have to change early on in their firm history. Now, we tend to find that okay. I think others see that as a yellow flag. We prefer that when Bob and Mike don't really work well together, not that we'd work great, I'm sure, but that we decide to part ways and do it quick. Don't make this last too long. So your point about team, and it's better to have less people, but highly committed, highly integrated people in terms of their simpatico on the world and how it should work and how this full firm is going to execute. That's what we're looking for. And so again, you can say to me, hey, I've got these two people. I'm going to hire 3 more people from within my network, or somehow people that I can make sure are going to fit into this firm's vision and its strategy. I'm much better with that than you coming to me with a bunch of resumes that all look good. And it's pretty clear to us up front, because we're looking for it, by the way, that you guys have no idea how that's going to work. We're not interested in that risk, frankly.
Yeah, so let me also cue you on a scenario, Mike. I've been told that a lot of times what people, they solve for the upside and the best case scenario, but they really don't deal with how people work together in times of stress, strife, and struggle. Talk about your experience looking at investment teams during stress and strife.
Yeah, it's an incredible important point. We actually think that is exactly the problem. And we've just been through this, right? At least in the public markets. It's one of the reasons, by the way, we tend to, in the public markets at least, shy away, not exclusively because we've made exceptions, but shy away from co-portfolio manager structures where 2 people are equals and make decisions together. Because at times of crisis, that's where that gets really hard. Now, again, the single PM model that we like has its own problems, which is there's no checks and balances. You can go through a whole list of things that can go wrong with that model. But Bob, getting to your point, it's all about times like these where you figure out what teams function really well, what teams don't. And one of the few pieces, there's a couple of things that I see as upside for those of us who allocate capital during this pandemic, one of which is to see how managers handle the stress of this. And I have to tell you, just as an aside, it's been interesting. All of our younger PMs and less experienced ones have handled this magnificently. The problem has actually been with our pointing at me too, our older and more mature and more settled people. They've had very few of them have had problems, but the ones who've had have all been in that group of, kind of the rock solid, been doing this 25 years crowd. It's really, I guess it shouldn't be surprising, but it still sort of caught me off guard a little.
No, that's very interesting. Thank you for sharing that. So let's go over to the next silo and talk about track record. This can be a hard one, but I'm fond of saying that in the emerging manager space, we have new firms, but not new investors, right? So if you're not a new investor, you've got experience, you've done deals. How do I talk about my deals? And really, Mike, if I work for someone else's firm and they're actively fundraising, how do I get attribution and credit for the deals? What happens in that? And if you have any stories to share, we'd love to hear them.
Yeah, I mean, that's a really interesting point too. I'm not sure I have great advice, but I will say this. We want to hear about your deals. I mean, that's the thing we want to understand. Obviously, as goes without saying, but I'll say it anyway, don't take credit for deals that you didn't actually have as much of a role on as you'd like us to think, because we're going to figure that out, by the way, and then we're not going to want to talk to you ever. But beyond that, most people don't do that, by the way. Most people are very transparent, very straightforward. But we want to hear about your deals. We want to hear about what you contributed to those deals in the private markets and the public markets. We want, a lot of times the people we're dealing with were former analysts, and they've never run a firm, they've never run a portfolio, so they have no track record. But if they talk us through how they make investment decisions, how they analyze companies, how they'll build a portfolio, then we can wrap our heads around, and same thing with the private markets, we can wrap our heads around what you're likely to do and how you're likely to react and how you're likely to behave. And that's good enough for us. As long as you're showing depth, creativity, some innovation in your thinking, and by the way, give us something we don't already have. That's another thing that has to be really put out there, which is one of the reasons you want to work with new firms. One of the reasons you want to work with more diverse managers is that you're getting something that you don't have enough of right now, and you want that, and you should want that. And that's a critical part of all this too.
Very good. And then the last category is strategy and execution, right? So every firm has a strategy. That's usually the thing that comes before the team and the track record. Talk a little bit about how you create a strategy that's effective, but also has resonance with the consultants and the evaluators from a capital allocation standpoint.
Yeah, so I think you start with I have a guy in this business who said this to me years ago, and I really walk around with it all the time, which is that investing is a deeply personal thing. So it's kind of one of the things I was referring to earlier, which is your strategy should somehow be born from who you are. What is the kind of investing that really works for you as an individual? Build a strategy from that. Obviously, it's got to be a real strategy. It can't just be that you like to do this or that. But once you've built that strategy, then start to help and work with people like you, Bob, or people like me who can help you flesh that out into a message that helps others understand that strategy better. Because if you can draw that line from this is who I am as a person, this is what I'm really good at doing, this leads to this strategy, and this is why it's going to do something good for you, Mr. Limited Partner, Mrs. Limited Partner. That's the way you do this. And I think once you get away from what does the market want, what had worked over here, what worked over here, but to who you are and how it translates through, I think you have a really compelling story. And it's something, by the way, that passion you have for what you're doing, which is almost a given, that comes through. And I got to tell you, I don't think there's a better thing in the world from marketing and business development than to show passion for what you do.
No, that's all very insightful. I appreciate it, Mike. Let's shift into a conversation about diversity. I have had the pleasure of traveling all over this country, going to a lot of conferences, meeting a lot of people. And one day I was at a conference and a dynamic woman asked a question. And she said that she was from, before I knew her name, she said that she was from Colonial Consulting, and she had particular areas of interest around emerging managers, diverse managers, definitions, and wanted to know everything that the speaker could tell her about it. I later went up to the woman, shook her hand, and asked her name, and her name was Angela Matheny. Can you talk a little bit about your colleague? And this is probably rare to do in an interview, but she's such a dynamic force and so committed, and she's got a wonderful story that's unique to Colonial. Can you talk a little bit about your colleague?
Yeah, in fact, there's a risk that I'll spend the rest of our time together talking about her. She is just an astounding human being. And actually, I will say, this is where you think about the dependencies in your life that lead to things that you never really imagined. Angela was brought into Colonial because our chief of human resources had known her for years, and she'd done some projects. And we weren't really looking for a head of diverse manager equity. There was no such position at the time. We were just looking for a good person to join the team. And Patricia Wortham, who's our chief of human resources, handed us a bunch of resumes, handed me a bunch of resumes. And I looked at Angela's. I said, yeah, I don't know why she'd want this job, and kind of put it to the side. And then Patricia said to me, no, you need to listen to me. This is somebody you want to talk to. So then Angela came in for an interview, and of course, Patricia was right. And Angela's, how can you not be totally engrossed and enthralled by Angela? And then she joined us. Immediately showed, her passion for diverse manager equity, lined up with one of the things that I cared deeply about, and we were off to the races. And then what happened, which I think is interesting, is Angela has done so many things, but one of the things that just really has stuck with me forever, and in fact, I give her a hard time about it today when she doesn't do it, is she was one of the first people I can think of in a while who were just brutally honest with me, and would say things to me like, hey, why are you saying that? That's ridiculous. You need to be more true. You need to be more honest. You need to be more of this, whatever the case would be. It was a relatively minor issue, just to be clear. And that I was like, oh, this is what I've been looking for, is somebody who's going to slap me in the face when I'm making mistakes and not doing what I said I would do. So fast forward to today, and Angela gets out there in the world, as you said, Bob, and she's just, literally before the pandemic, I used to travel like 275,000 miles a year globally. And I think Angela was more domestic, but she traveled as much as I did, maybe more, and just got out there in the world and got our message out there, which was, hey, we want to talk to you as managers. We're interested in you. We're not going to love everybody. That's one of our bugaboos that people don't like, but we're going to like a lot of you, and we're going to allocate capital to the ones we like. She got out there and did that. Inside of the firm, she provided leadership, persistence around this issue and around all the issues we faced. And in fact, that led to really earlier, I'm getting my years confused, earlier this year, late last year, moving her into basically being the chief of the investment staff. So she runs the entire investment team at Colonial alongside me. And she's not just the head of diverse manager equity, but she's still doing that too. So she is a total force of nature, I have to say. And if you want to, I think our entire team has done an amazing job on diverse manager equity. However, without Angela, we're not here. End of story.
So, Michael, you've said a lot in that answer, and I actually want to unpack it a little bit, because a lot of what you said, frankly, becomes the elements of a case study on how diversity should be executed. One of the first things you said is that somebody made you go back and look again. And I'm going to call, I forget the lady's name, but I'm going to call her a champion, right? because she believed in an individual. She was committed to helping you get to a good answer. And she kind of, I don't want to say she forced your hand, but she drove accountability and made you go back and look. Talk just a little bit more, not about what happened there, but about the importance of champions as it relates to career and diversity.
Yeah, you said it so well. You know, first of all, everybody needs people in their lives who call them on their crap. I mean, so that's the first thing. So that's a separate issue, but that is just, if you don't have anyone in your life that does that, then you need to go find that person somewhere in your world. But in terms of what you're asking about, you need to have somebody who is just relentless and is a champion for, as you said, for individuals on the team that need a champion, and people need them more or less at different points in time in their career and their lives and their day. And you also need somebody who's a champion for an issue. And so in this case, we had Angela, who was a champion for diversity. I mean, admittedly, operating within an ecosystem that wanted a champion for diversity. I mean, that's a really important part of this. But that's the thing. There needs to be somebody who, this is what they care about deeply, and they're not going to let it go, and nor should they. And so that's the concept of champion. And what Angela's taught me, by the way, too, is that you said it too very well, Bob, which is it's not just champion for ideas, it's champion for the people that work on those ideas, that work and become the fabric of your firm. You need to think about that. You need to nurture that. And that's one of her things that she does really well.
So the other big one beyond champion that you talked about, and you called it people that won't let you get away with your crap, we're going to clean that up and call it accountability, right? And creating accountability in a corporate culture, there are CEOs that have all the power in the world that can't create accountability at times. It sounds like you've found in a person and in your team the ability to drive accountability from any number of reasons. You can tell us the reasons, but is that what you're really talking about, an accountability culture?
Yeah, it's all about accountability. And it's also, by the way, accountability, but within the right framework. It can't be, oh, you made 3 mistakes last year, you're no good. I mean, that just can't be that's not accountability. But accountability is, these were your decisions. This is the implications of those decisions. These are the things we expected from you. And did you do those things? That's accountability. But then there also needs, at some level, this is something we've been very focused on. It's been one of the secrets of our success in terms of expanding our manager universe to have much more diversity, is accountability to me is about ownership. So I needed more people on our team to truly own the ideas in their portfolio. I was talking about managers before, owning a strategy and having it come deeply from within. Well, I've got 18 people on the invest team at Colonial who all express their individualism through the managers they own. It's a very personal thing for them. They fight for their managers. They fight me all the time about whether we're not doing enough with them. And that part of it is so important, Bob. It's that ownership, which then, of course, if you're going to own it, you need to take care of it. And you need to prove that you've made good decisions over time more often than not. And that's the last thing I want to say is very important in our culture, is risk-taking is what we are here to do. A lot of people, I think, in the investment business are trying to be risk averse, but risk aversion is a ticket to mediocrity and a ticket to less return. We need more return, not less return. So you have to be a risk taker. And our culture, and Angela's been helping with this too, is all about training people to be good risk takers. And what that means, by the way, back to accountability, is you can fail. And in fact, if you never fail, you're not taking any risks. And so we're very, very focused on that as a team, that we need to be able to make mistakes. We need to be owning our mistakes and transparent about them. And trust me, I talk probably more than anyone wants to hear about my mistakes to the team, because I need them to understand that I've made plenty and I will make more.
Well, you've covered a lot of great topics in that. I appreciate your insight. Let me go to what we prepared for, and I appreciate your flexibility, Mike, and let me talk about all these other observations of Bob. Talk to us about how diverse and emerging manager programs work within Colonial, what work you do on behalf of your clients, and what you bring to that theme of working with diverse or emerging managers.
Yeah. Great. So let me start with, we do separate the two. We actually don't consider emerging managers a specific theme, although we do a lot of that too, depending on how you define that. So we're very focused on the diverse manager side of this. And what we're doing is really starting from a very simple principle, which is that, I mentioned this before, that you need to basically to be successful as a long-term investor, you need to essentially embrace volatility and uncertainty in your portfolios. And you do that responsibly by being diversified in the portfolio. So that diversification is only done well if it actually attacks the issue of diversification way beyond I own stocks, I own bonds, I own hedge funds, I own private equity. That's not good enough. It also needs to attack it in terms of what are the opportunity sets that I'm operating in? Do I have a very good spread of those? What are the spheres of competence and excellence that I can find in terms of investment people, investment firms that operate in these different areas? And three, where do I get a variant perception? Where do I get differentiation? And you find that in a lot of different ways, but you find it incredibly powerfully within basically a diverse manager community, because everybody has different life experiences, and those life experiences will contribute to who we are. And if you're investing as a personal reflection of who you are, I get all of that differentiation. I get all of that diversity inside my diversification. So that's the operating principle here. So then what you do in terms of creating a good program, you get out there in the world like Angela's done, and you drum up as much interest as possible. You open up that funnel, make it fair, make it broad, make it overwhelming at times for us, frankly, and then pick out those exceptional managers inside that group, and then go to the clients and say, whether they've talked about diversity explicitly or not, explain that differentiation is valuable to them. Say, hey, here are 3 examples of great managers who are going to add to your portfolio in part because of their talent and in part because they're different than the other managers we have in the portfolio. And then 3, now what's happened really since the murder of George Floyd is clients have become a lot actually more focused on the issue, which is great. So we're also selecting clients, suggesting clients in terms of investment policy statement language that can be used to codify this idea, because it not only is a great investment idea, it's actually a great value that we all want to carry, and a lot of our clients want to carry forward as well.
So, Mike, it's fair to say that you didn't go to school for this, meaning to become a diversity investment, a diverse manager investment consultant. You didn't go to school for it. I can't imagine that there was a conference that just gave you some extraordinary insight into doing this. Where did the motivation come from? And you mentioned about taking risk. What made you want to take a risk on going long on diverse managers?
Yeah. Well, first of all, mine is too long a story, but mine is a journey of a lot of people like me who basically grew up with every privilege you could possibly imagine and never once even thought about whether this was working fairly for everybody or not. It just didn't even occur to me. 7 or 8 years ago, though, a client said to me, hey, this is a real issue. Have you looked at it? And of course, I blithely said, oh, well, I've never looked at it, but I'm sure we're doing great. Then, of course, it gets back to accountability and measurement, which are incredibly important things. We went back and measured, and the measurements were, needless to say, a little disappointing. And that was really shocking to me.
Tell us what you measured. Tell us what you measured.
Yeah, we measured how many diverse managers were we recommending to our clients. This is back in 2013. And how much capital did they have? And the answer was, I think I don't remember the numbers, but something like we were recommending 5 diverse managers maybe, and they had $150 million out of our, at that time, 27 billion or 23 billion. I don't remember the numbers exactly. It was pathetically low. And it was probably no different than a lot of the industry studies today show in terms of exposure and asset allocations to diverse managers. So fast forward along the time. So you first start off with the denial. Then you get to the, oh, this makes me feel bad about myself and about my firm, and you maybe don't want to deal with it. And then you wake up and you say, I need to do better. We can do better. And for us, it was somewhat easy. And for me personally, sometimes easy, because I've always been attracted to things that are different than other people are doing. Just love that as a whole investment concept. The whole idea of being contrarian is very much my DNA. So for me, and then for others on the team as well, not just me, we're like, well, let's start looking. And we started looking. And it was admittedly, unfortunately, it was a part-time effort, right? So it moved along. It had great intentions. It didn't have incredible ferocity behind it. And then, like I said earlier, then Angela shows up on our door out of nowhere, and she brings ferocity and passion and takes this whole idea and gets us to where we're at today. But the light bulb, Bob, and this is the thing I really want to encourage everyone to think about. The problem I think a lot of allocators have, and I know I had, is if you spend literally your entire career only talking to, essentially, generically speaking, white men managing money, you kind of think that's what a money manager looks like. And it's not that you're a bigot per se, it's that this is what you're used to. So the secret is simple to fixing that. Go out and meet more people that manage money that are not just white men. Talk to them, learn about them. And you walk away and say, wow, this is pretty cool. This is all, you knew it existed, but when you actually talk to people and have personal experience with individuals who are exceptional investors that are not just white men, you then sit there and you say, wow, it's obviously true, but now I can see it, I can feel it. I've broken the pattern recognition problem that we've had. And now I can get to that next stage, Bob, which is the excellence is not just there. We knew it was there, but we can find it, we can access it, and we can get clients to invest in it. And now we've got the most perfect thing of all, which is differentiated excellence. And that's the concept I was talking about at the beginning. But you have to go on that journey to go from denial, some acceptance of the problem, start working on who those firms are, find those firms, and then say, this is really cool. And then I will stop on this. I'm much of a long-winded answer. But what I really remarkably has occurred to me, especially during the pandemic, is to see how our diverse managers in some cases have done things that are very different and very sometimes successful in their portfolios that I don't think any of our other managers would even thought to do. It's because they come at the world from a very different perspective, and that is just proof.
Outstanding. We had a little bit of a blip there. I'm not sure if it was on my end or your end, but hopefully you guys can hear us okay. Mike, that was an amazing answer. And one of the things I was struck by is your description of it being a journey. I'm going to ask you to play cognitive psychologist here for a minute. Where would you say the IQ of your team, the 18 or however many investment professionals, started in 2013? And where's the team IQ around working with diverse managers today? In terms of what do they know, what do they believe, what have they validated? Talk to us about what has happened cognitively in terms of your team's understanding around this.
Yeah. So if you go back to the beginning, I would say that first, our team itself is very diverse. Our firm is very diverse. And by the way, that was my behavioral mistake, which was to assume that if you build a diverse team, you will end up with a diverse pipeline of managers. It doesn't actually work that way. Very naive of me, I know, but that's what I used to believe, and that's what I had to learn. So diverse team. So clearly you don't have people who are opposed to the concept. But in the beginning, we definitely had a lot of concerns around two things. One was, the biggest one was, hey, Mike, you're out there telling the clients and telling people that we're doing this work. What if we can't find managers quickly enough? What if you feel like we're not living up to our promises? Are you going to do something which we want? We really will be upset if you say we should do, which is to hire a manager so we can kind of check the box, so to speak, find the B+ player and say, well, you know what, we need to be able to say we found somebody. So they were very concerned about that in the beginning. And that was partially because, who did know? We didn't know, frankly, and this is the part I really want to emphasize. We didn't really know how easy it would be to find great firms. Without having done it, you don't know. So you have that kind of nagging concern. So those were the problems in the early days. And I had to continue to say to them, we're not going to do that. I'll go out there and tell people we're still working on it for as long as that takes. But we're going to make a massive effort, because I'm not going to go out and say that if we're not actually trying and doing the work, because I can't believe that we can't find firms. We're going to find firms. So fast forward to today, there's a large segment of our team that I think there's two things that have happened. There's one segment of our team that I think is just completely enraptured with not just finding great managers, but it's even better when you find an incredible diverse manager, because they just feel like that's even more of a bonus than finding just another great manager. So I really love that dynamics emerged on the team. And then the second thing that I see happening on the team is no one ever asks whether we can do this or not. Everybody has seen it. There's a broad array of analysts inside of the firm that are promoting diverse managers, because back to ownership, we got rid of our silos. That was a major behavioral problem in the firm, is having hierarchical silos. That's what creates bottlenecks and approval processes. So now within our team, any two senior members of the team, which is basically most of the 18, can own an idea. It doesn't have to be an idea that I wanted to own. They can own an idea with or without my blessing, so to speak. And that's critical, Bob, because now they own these firms. And what really happens now, when I look at those stats, I can see that the ownership of diverse managers inside of our team is, I didn't do the calculation recently, but it covers more than 80% of the team now owns several diverse managers. And that tells you a lot about what people are doing. And again, remember, I'm not giving them any, you don't get to say, oh, that manager didn't perform, I made a mistake there, but they're a diverse manager. That doesn't fly. Every manager is being held, and every research analyst is being held to the same standards as they should be. And that's working beautifully right now. So we're feeling really good. So our team's IQ and EQ on this subject is really exceptional today. I'm really proud of what they've done.
So, Mike, I've known you for a number of years, and you've never been afraid to speak your mind, and you've never been afraid to be a contrarian and stand alone. Hopefully, you'll follow me with this question. Why are so few consulting firms comfortable with executing in this space and volunteering to clients that they can take on a search as opposed to waiting for the excuse of the client to ask them for it?
Yeah, I am pretty outspoken. I'm probably going to disappoint you here, though, a little. I really don't know. All I would say, though, is to my colleagues in the industry is that there really are no excuses for this. This can be done. Every firm, by the way, if you think about everything I've said on this call today, there's no rocket science there. There is no active genius on our part. I'll speak just for myself, not for the team, because they're special, but I'm not a special person. I'm an average person who cares about his clients, wants to do the best for them possible, and cares about the world. And I can't believe that 99.9% of the investment consulting industry isn't exactly the same or better. And therefore, stop making excuses. Acknowledge that you probably have to do something different than you've been doing it. Figure out what those bottlenecks are in your process, and just stop talking and start doing something. I will say I do find it frustrating when people tell us about all the things they're going to do and how they're going to make this change, and we all applaud, fabulous. But it's all about accountability, and it's all about allocating capital to a more diverse group of managers. Because, by the way, even if you don't care about diversity in any way, shape, or form, you've got to acknowledge it's better for your clients. It's ultimately then therefore better for you. And you should just do it and stop talking about it.
Excellent. So I'm going to give you an opportunity to talk about a few different things. I know that we're not going to break news on here today. You have some news, but you're not going to be able to share that, and I respect that. No. Can you talk about the process, the driver of the process?
Yeah, so the news is that, again, I'm not going to break anything. Sorry, Bob. I would love to, but I think that would be the end of my career. We have been working for actually over a year on the name Colonial Consulting. So this is not just because of the world and the changes that have occurred this year in the world and some greater acceptance of a lot of deep-seated problems in our society. This started before that. But with that said, we've been on a journey to say, we need a name that reflects who we are as people, and Colonial is not that name. None of us created that name. It was the name from 1980. Even the old guy like me who joined in 86 wasn't here when the name was picked. And frankly, one of the things we've talked about, and we have a diversity report coming out, and we wrote a letter in the back about this. We referred to the name and used the expression, we're done allowing inertia to overcome basically wisdom. And the wisdom here is that the name needs to reflect something that says who we are and what we bring to the table with our clients. And, by the way, there's a lot of different things. It starts with investment excellence. It starts with supporting our clients in every way we possibly can. And it deeply, deeply includes diversity as one of the major, if not the most major and important contributor to investment excellence. That's going to be, when you're hearing about our new name, and we're going to be a lot more of a public presence, we think, in terms of social media. Events like this, Bob, giving us the opportunity today is we want to do more of this. Want to be out there talking about this, and just being hopefully an example of not perfect, but trying, and that you can be successful with the right amount of effort. So that's the name. It's coming, and it's going to be. I think half people are going to hate it, half people are going to love it. Maybe there'll be a group in the middle that doesn't care, and that's okay.
Well, I tell you what, whether half the people like it and half the people don't, the process you just described, the driver and the sincerity around why you're doing it, you mentioned it, people allow inertia to beat wisdom all the time. And I like the fact that you're going to put wisdom ahead of inertia, because that means that you're not afraid to work hard and you're not afraid to compete again. So I'm happy for you all on that. And frankly, I'm not surprised given the caliber of people I've met at your firm. So we've got a few minutes more. You can take a quick exhale. We've got a few minutes more, and we don't have an ability to really get questions from the audience. So I'm going to give you a couple of more questions. And I want to focus now on the future. What does Mike see in the crystal ball? So the first thing I want to think about is, let's go back to the broader industry. Where do you see capital flowing in terms of private equity strategies and hedge fund strategies? What do you think dollars are going to be flowing in over the next 3 to 5 years? What's a good place to meet the dollars, in the sense of Gretzky meeting the puck?
Yeah. Well, I think, this may not be the best opportunities, generically speaking, but I think this is where the dollars will flow. I think dollars are likely to continue to flow towards innovation. So that's venture capital for sure. To the extent that this crisis we're in is as long term as it could be, then you're going to see, a lot of dollars flowing into distress strategies, whether it be real estate or corporate distress. I think that's another area. I think you'll also see hedge fund managers that operate within the distressed worlds attracting capital. So those are the places I think dollars will end up flowing to. And we'll have to see how that all turns out in the end. But that's where the momentum is these days. And I think momentum is, as you know, a very powerful force, Bob.
Michael, what do you think about, we've now had a generation of diverse managers that have had extraordinary success. They are effectively, selling stakes in their firm and becoming billionaires. What do you think about where the industry is headed in terms of the next generation of managers? And is it going to be the same task and challenge for them, or are they going to be tasked and challenged in some new and unique way?
Yeah, I like to think that the challenges will be different for them, and in some ways a little bit lesser. I'm not sure that's how it's going to play out, but I'm optimistic, frankly, that it will. And so I think this next generation and the current generation of diverse managers, I think we would love to see happen now is to get away from the handful of success stories than the diverse manager community, defined, as you said, not by performance, but just by being able to actually raise assets, being able to get the kind of wealth that asset managers generate across the spectrum. If we can get away from the exceptions and towards there's hundreds of great diverse manager firms out there that are raising capital effectively. And actually, this isn't the ridiculous, I know, but we don't even actually have these conversations anymore. We just go out and start hiring great managers from a level playing field, and we have diversity just as a natural outgrowth of that. But that's what I'd like to think this next generation, I think they're on the cusp of it, because I will say this, we see tremendous, the investment management industry, and I love the industry, as you know, and I love investing, but it's the creativity and the intelligence and the discipline and just the pure grit that it takes to succeed in this business. I see a lot of people who have those characteristics. And I'm focusing for the moment, it doesn't exclusively exist here, but on the diverse manager community, you can just see it and you can feel it. And I can't believe that will not translate into the success that almost every one of the people I'm thinking in my head deserves. So I'm really optimistic that that's what we're going to see. We're going to see the quote unquote the normalization of diversity as something that just is it just is, and it's good. It's better than good, actually.
Young people on the call thinking about their careers, thinking about investment management consulting. If they're interested in that type of career, first of all, what should they be doing today? And where do you think the investment management industry is headed in the future?
Yeah. So I think people should be doing today is kind of discovering that personal investing part of it. You got to learn the nuts and bolts about what investing is. And there are, tremendous, we're sponsored one of, there's lots of great internship programs out there and college courses and high school courses and things to learn about the nuts and bolts of finance and investing. Read books. Reading is the best thing any investor knows how to do. I think it's probably the thing most great investors love the most. But do those things. And then find yourself as an investor, and you'll go work for other firms, and you'll see what other people are like as investors, and you'll borrow things from them, and you'll learn things from them, and that's great. But then find yourself as an investor, even if it's off to the side during your off hours from work. You do those things, and then you kind of come out in the world as an investor. And if we actually did have a capital allocation system, which gave you a real shot at showing that you're special at what you want to do, I think you would find a tremendous audience that wants to fund you, wants to put you in business, and wants to make you a success, because we're all in that together. So those are the things I really think about. And, from my perspective, that's why I also encourage all the firms, and we're doing it, a lot of other firms do this too. We need to build the pipeline for the future. So our internship program at Colonial is all about, selfishly, I tell the interns, I told them today, actually, hey, one of the reasons we do this is we want you guys to be successful. Of course, we want you to have great lives. That's really super important. We're also selfish. I want some of you to go in the investment management business, and I want some of you to remember that Colonial is the one that kind of was there when you were in high school or a college kid. And when your fund's oversubscribed, you're going to let my clients actually have more of the fund than anybody else gets. I mean, I'm just being a selfish person from that perspective. But we just need to have this thought process, Bob, around the long term about stimulating a pipeline, nurturing people along the way. And it's particularly true in the diverse manager community, where there just aren't as many examples of where you go, what that path looks like, what that feels like. And that's why if you do get to what I said earlier, which is a broader array of well-known managers in the diverse community that are success stories, you create that image for people, you create that path. And a lot of young people see that and say, you know what, I can do that too. And they can. And that's the beautiful thing.
Well, Mike, that is a good place for us to wrap up today. I want to thank you. You've been very generous with your time in terms of prepping with us, doing a run through to make sure that everything worked, and then obviously being very thoughtful about your answers to the questions that I'd asked. It looks like the next time we speak, you will not be at Colonial Consulting, but you'll be at the same firm with a new name. So I'm excited for you and your colleagues about the name and the brand change, but looking forward to the culture remaining the same and looking forward to the continued relationship you have. I also want to thank you. The first consulting firm to become a member of NAIC was Colonial Consulting. So I want to thank you for sometimes being uncomfortable, because we're unapologetically an advocate for managers. And sometimes, we're guilty of saying and doing things that a consulting firm may not always like. I appreciate you guys embracing us. I won't even say tolerating, embracing us and working with us. And again, want to thank you for the work that you do, and want to thank you for the support and the leadership of your colleague, Angela Matheny. That's a wrap for today. Thank you for being with us on NAIC Insights. Thank you, Mike.
Thanks. Thank you, Bob.